Good morning to all. I am Muthu Selvi, Assistant Professor, Department of Commerce with Computer Applications, Dr. SNS Rajalakshmi College of Arts and Science, Coimbatore. Now I am going to discuss about the topic of financial marketing. First, we know about the meaning and definition of financial marketing. Financial market is a broad term that emphasizes a variety of platforms and institutions where buyers and sellers engage in the trade and financial assist. The assets can include stock, bonds, then currencies, commodities, and derivatives. Financial markets plays a crucial role in the facilitating the flow of capital between those who have excess funds, that is investors, and those who are needed funds, borrowers or issuers. The key components of the meaning of financial markets are: first one is assets traded. First, assets traded include equity markets, debt markets, foreign exchange markets, commodity market, and derivative markets. In the equity market, those were the stocks of owners. The ownership of a company are bought and sold the stocks. Debt markets were bonds, that is, debt instruments representing loans or traded. In foreign exchange market, where currencies are bought and sold. Commodity market, where physical goods like gold, oil, and agriculture products are traded. Then derivative market, where financial contracts derived from the underlying assets are bought and sold. For example, futures and options. Next one is the functions: primary price discovery function, liquidity function, risk management and function, and capital allocation function. These are the four functions are involved in the financial markets. First one is price discovery market. Price discovery function. Financial market skills establish the fair market values of assets. Those are interaction between the buyers and the sellers. Liquidity. Markets provide a platform for the investors to buy or sell the assets easily, ensuring into the liquidity position. Next, risk management. Derivatives markets allow participants to manage and huge risk allocations with the price fluctuations. Capital allocation. Financial markets allocates capital efficiency by directing funds to companies and projects with the most promising prospects. Next, for third category is participants: investors, issuers, brokers, and dealers, and regulators. These are the majority of participants involved in the financial markets. Investors are in the category of individuals or the institutions or the enterprises buying financial assets. In issuers, entities raising capital by issuing stocks, bonds, and other financial instruments. Brokers and dealers facilitate trade by connecting buyers and sellers. Regulators, government agencies overseeing and regulating financial markets to ensure their practices and the stabilities. Next, types of markets. There are four types of markets. One is primary market, secondary market, money market, and capital market. Primary market, where new securities and are issued and sold for the first time. That is, market is called primary market. Secondary market, where existing securities are bought and sold in the market by the investors. Then money market deal with the short-term debts, instruments, and financial assets. Then capital market involves buying and selling of long-term financial instruments. Uh, Buying and selling in the capital market. These are the four major types of markets in financial marketing. Next one is scope of financial markets. The scope of financial markets are vast and dynamic, emphasize the various segments that facilitate the flow of capital, investment, and financial instruments. First one, capital market. Second one, money market. Next one, banking sectors, then insurance sectors, regulatory framework, and microfinance and non-banking financial companies. These are the major segments involved in the financial markets. Thank you.